President Joe Biden already implementing new energy policies on his first day in office, signing executive orders to rejoin the Paris Climate Accord and revoking the permit for the Keystone Pipeline. So what could this mean for the long beaten down energy sector? Our next guest says there's actually still a bull case for big oil as we get into the new year. Let's bring in Paul Sankey of Sankey Research. Paul, great to have you with us.
Hey, how are you?
Good. We talked about how a Biden administration could be bullish for big oil. Can we have a scenario under one single administration where big oil benefits, but also alternative benefits?
That's certainly the way the market's playing it right now. As you know, we've seen very good performance year to date. Okay, not many days, but nevertheless, the oils have been the strongest sector in the market pretty much. And then, of course, you've seen huge performance from the solar names, the hydrogen names, EV, electric vehicles. So at the moment, everything's working in the same direction. I tend to think the latter are basically in a bubble. I don't want to fight it, but I don't think they'll be valued this way in 5 years' time, particularly not if we're looking at an inflation environment and a weak dollar environment. That's really the bull case for oil prices and the oils, I think.
Is it a bubble, Paul, though, if there is, because you make the point in the notes that I've read, that there is so much money in this alternative energy trade and not enough places to put that money. And so that's why we've seen huge runs in, let's say, a Tesla, for instance. If that big money still exists and its mandate is to be invested in alternative energy, is this really a bubble? Is this a trade that can actually just keep working?
Yeah, I mean, look, think about the internet bubble. The market was brilliant at identifying the future of the internet as being an absolutely enormous story. And you could have bought Amazon at the top of the internet bubble and made a lot of money. The same applies to Apple or Microsoft. But at the same time, obviously, you had your pets.com. For some reason, it's the one that everyone always remembers, but there was a lot of them that were absolutely worthless. And that's because Google and Facebook and Netflix didn't exist at the time. So, you know, I think there will be some remaining winners from the top of this bubble, but there'll be a lot of them that go to zero. And there'll be a next generation of companies that really come in behind. And what we're really doing is pre-financing this shift. But the next 10 years, reality will kick in. And that reality is that we still use a ton of oil, 100 million barrels a day of oil, we expect by the end of this year. And really, hydrogen is not happening at all.
Hey, Paul, it's Tim. Thanks for joining us. Why does it take the street or energy analysts to have a 40% move in the XLF outperforming the S&P to finally upgrade energy and say this is not just a trade? But there's a couple big houses that are actually calling this an investment. And it's puzzling to me why this happens in general. But what is the investment thesis?
Yeah, I remember one of my bosses asking me, Paul, how can you always be so wrong on oil? And I said to him, I'm just less wrong, mate. But the other point that he covered transport. And I said to him, you know, since when covering transport do the Iranians show up in the middle of the night and move all the train tracks? And one of the things we had this year, which was completely a surprise, was Saudi unilaterally, which they haven't done for many years, saying that they would cut 1 million barrels a day of production right as we were facing this sort of semi-COVID resurgence or COVID hanging on longer than we had hoped. The Saudis stepped in and really changed, you know, added $5+ to the barrel of oil. So we just get those external factors. And that's a negative, as you know, for the stocks. People don't like that volatility. But the reality is, I think people do see a genuine tightening occurring in the market, a genuine new capital discipline and better strategy from the US E&Ps, and really just needed that confirmation that we've got of near-term oil prices going up. The problem is the back end of the curve, 5-year forward type prices, hasn't really gone up at all. So it'll be interesting to see if we get a genuine follow-through from this early start to the year, which has been so positive.
So, Paul, this is Steve. Quick question for you. So the Keystone Pipeline seems more like a symbolic gesture on President Biden's behalf. It seems like that was telegraphed to the energy space. Canada's supply is not increasing. They're building other pipelines. Basically, the Wall Street Journal said that they're building a $1.7 billion pipeline, or they plan to build one, and it's going to be a clean pipeline. Should we be afraid of the rhetoric or just invest right through it?
We're not sure. We think that Biden is going to be pretty rational. He comes from a refining state, Delaware. There are union issues, even related to the Keystone XL. And while we think there'll be a lot of rhetoric, like rejoining the Paris Accord, it actually doesn't make any difference in terms of the reality of, the next 5 to 10 years. As you know, the Keystone XL pipeline wasn't needed anymore anyway, basically. So it was totally a symbolic gesture. It might even be that it's a stalking horse for them to let the DAPL, the Dakota Access, which is more important, far more important in real terms. That might be a way for them to actually let that keep going. We'll see. I think that Biden's going to be pretty reasonable in terms of keeping the U.S. economy going and not going too far down the line of turning back everything, which DAPL being an operating pipeline, the Dakota Access pipeline I'm talking about, of course, that is currently operating. And to start turning back existing operating pipelines would be a significant negative. And I just think that economically there's an awareness in the Biden administration that the economy is a big issue here. And if you start hurting the U.S. oil and gas industry too much, it's not going to serve you well at all. And I'm hopeful that this is going to be a pretty rational balance. And that's one of the reasons why we like the oils here, actually. We think that the fears of things going really bad are overblown. And in fact, the outlook is pretty strong here, because what we've seen in COVID is demand for oil is structurally very strong. And that's what COVID has proven to us. Once we get through it, we could see really strong oil demand over the next 2, 3, 4, 5 years.
Paul, during a past appearance, you made what some might call a controversial a call for a trade, which was long Exxon, short Apple. And on a relative basis, that trade has worked. Since August 25th, which is when you made that call, Exxon is up 17% and Apple is up only 5%. Would you stick with this trade, or is there another pair trade that you would like to put in place or call for at this point, especially given the comparison to pets.com and to some of the solar names and alternative names right now?
No way, I retire. No, I'm kidding. I was thinking about this. I thought Tim Seymour would bring it up, actually. But, I'm the analyst that tagged EOG, the Apple of oil, because of its technology. And so I was thinking, how can I get another trade like this going? So let's go long EOG, short Tesla. Let's do it.
All right. It's documented. Paul Sankey, long EOG.
And by the way, the other trade,
Tesla.
if you remember, was a 5-year trade. We'll do it on a 1-year view.
Okay. All right. A 1-year view deal. Paul, thank you. Good to see you. Paul Sankey of Sankey Research. Guy, do you like that trade?
Hi.
Hi.
It's interesting. I remember when he said it, and actually, if you go back, we talked about it. Paul said it's probably not right here where you're buying Exxon, and then we had a whole conversation about where it could potentially trade down to. And for you technicians out there, 31.5, huge double bottom. And think about it, Exxon is up almost 60% since the November low, which is staggering. So Paul's being humble here. He actually he gave a little bit of mitigation and said it probably has a little more room to the downside. So spot on. I think Exxon trades up to 53, which was the June high. You had 3 analysts last week. I think it was J.P. Morgan, Barclays, and I think Goldman Sachs all upgraded the name, to Tim's point, really late to the dance. But I do think it continues to rally into earnings, I believe, on February 2nd. So good for Paul Sankey. And I could listen to him read the phone book, by the way.
Shepard Smith here. Thanks for watching CNBC on YouTube.